I read 40 books about money and investing to learn what will make you rich. Turns out there actually is a proven formula to it. It's simpler than you might think, and I'm going to tell you what it is through the story of 16 great books. But you know what? Let me get rid of some of these first, and then we'll get started. In researching for this video, I discovered that there are over 50,000 books about investing on Amazon. So why did I choose the 16 that I did? As a former equity analyst on Wall Street and chief financial officer of software companies, I have a ton of education and experience in finance and investing. But the more I've learned, the more I've grown to appreciate that the simple approach really is the best way to go. I was looking for books that were enjoyable to read, that encouraged and empowered people to take action to improve their finances, and it explained exactly how to do it. Importantly, I wanted books that showed what works and what doesn't work and why. I believe understanding why something works is really important because it helps people do the right things and stay the course. In short, I was looking for the best books to help people achieve financial success in their lives. So here's what I learned. Book number 1, Napoleon Hill, Think and Grow Rich, published in 1937, discussing 13 steps to achieve riches. Even though it was published almost 90 years ago, its lessons are just as relevant today because they're about human psychology. One of his main teachings was that we can greatly increase our odds of achieving financial success by using the power of self-suggestion. By telling yourself every day that you will achieve a certain dollar amount of money by a certain date, you fill in the date and the amount for yourself, and by imagining yourself in the future with that amount of money in your account. By really feeling that success, your brain will believe that you can accomplish this goal. This builds self-confidence and what he calls an unshakable belief to help you both consciously and subconsciously take the actions necessary to achieve the goal and to propel you through the inevitable challenges. You may have heard this stated another way, which is that whether believe you can or you believe you can't, you are right. The choice of which one is up to you and the actions that you take or don't take. Number 2, In Your Money or Your Life by Vicki Robbins, the author reframes our choices about work, money, and our spending habits. She points out that most people spend their lives working a job that just wears them out and spend money without giving thought to whether or not the thing they spent money on even brings them much joy. One important reframe that she offers is this. Think of the money that you earn as being life energy, since you traded a portion of your life to get it. Then diligently track and analyze your purchases, not in terms of how much money you spent to buy each thing, but in terms of how much of your life's energy you gave up to buy it. With that clarity, you can then become diligent about eliminating purchases of things that aren't worth the life's energy that you would have to trade in order to buy them. Number 3, The Simple Path to Wealth by J.L. Collins is based on letters of advice that he wrote to his daughter about money and investing. He teaches the importance of having what he calls FU money, which is enough money that even if you lose your job or you want to quit your job, it doesn't matter because you have plenty saved up. He also teaches that the more things you own, the more they own you, since you have to take care of ever more stuff. A really important learning is that being independently wealthy is a combination of how much money you have as well as your ability to limit your needs for stuff. The more you need, the more money you need to pay for it. And conversely, the less you need, the less money you need. And therefore, if you need less, you can be independently wealthy with less money. Number 4, I Will Teach You to Be Rich by Ramit Sethi takes you through a 6-step program in order to get your finances in order. While some personal finance authors emphasize saving as much as possible, Sethi recommends a more balanced approach. Rather than talk about budgeting, which he says that he and pretty much everyone hates and would never keep up for long anyway, he talks about what he calls conscious spending. To Sethi, conscious spending means you first determine and set aside dollar amounts for various needs that you have for your money, with an emphasis on spending on the things that matter to you. Things like food, rent, and savings, ruthlessly cutting out the things that don't matter much to you, and investing healthy amounts regularly in tax-efficient funds. Importantly, as a part of this, you allocate to yourself an amount each month that you can spend on whatever you want for guilt-free spending. By carefully managing how you spend and invest your money and giving yourself an allowance, you can feel really good about your finances. Book number 5, In the Psychology of Money by Morgan Housel, understanding and managing our own thoughts and psychology, which drives our behavior and therefore our results, is so important. The author says that when it comes to finding success in investing, how you behave is more important than what you know. I think he's right. You need to know enough about investing to understand the different investments you can make and how to build a portfolio, but after that, it's what you do over time that matters. People tend to react the wrong way when the market fluctuates, and this book makes us aware of these errors so we can control our emotions and therefore avoid hurting our finances. Through the use of short stories to illustrate each point, the author shows us why certain investing behaviors are so important. Things like giving yourself a long time horizon, saving regularly, saving as much as you can afford, investing whether the market is going up or down, not letting yourself get scared into selling just because there's a recession, avoiding financial leverage because of its potential for financial ruin, and always planning for something to go wrong. Book number 6. The Millionaire FASTLANE by M.J. DeMarco categorizes people into 3 groups based on their general approach towards money. He's named these groups the sidewalk, the slow lane, and the fast lane. People in the sidewalk group spend whatever they earn with little regard for saving for the future. This group is always just a few paychecks away from financial disaster. People in the slow lane, on the other hand, have financial discipline. They save, they live somewhat frugally, they follow the traditional advice to build a good career while investing over the long term for a secure retirement. In DeMarco's opinion, while the slow lane is definitely better than the sidewalk, it's still not the best approach because it requires a very long time and it relies heavily on factors that we don't control, like not losing our job at the whim of our employer and unpredictable stock and bond market returns. Because even if all goes well, it's unlikely to make you truly rich, and getting rich is his stated goal. DeMarco argues that the fast lane approach for someone who wants to get rich may be the best choice. The fast lane involves starting and building a business that meets certain criteria, not just any business, which he details in the book. He prefers the fast lane because, if properly executed and if it works for you, it can make you a lot richer than the slow lane approach, and it can do it a lot faster too. The fast lane approach is not get rich quick or get rich easy. It will definitely require significant effort, but DeMarco argues that it offers the best potential financial return for the amount of time and effort involved. In terms of best overall strategy then for building wealth, DeMarco recommends a blend of slow lane tactics like living below your means and saving regularly over time while building a business in the fast lane. Thomas Stanley and William Danko of The Millionaire Next Door came to similar conclusions. They spent years studying millionaires to learn who they are and how they got rich. They were surprised to find that the typical millionaire is probably not who you would expect. For example, they learned that more than 80% of millionaires accumulated their wealth themselves in one generation. They did not inherit it, and that about 2/3 of millionaires are self-employed. They identify 7 traits that show up again and again among those who have accumulated wealth. Traits such as living well below their means, spending their time and money wisely in ways that help build wealth, and choosing the right occupation. Sound familiar? This book validates among actual millionaires that the ideas that we've learned in these other books actually work. Number 8, Rich Dad, Poor Dad by Robert Kiyosaki is a tale of 2 dads, each with a different mindset about money. The poor dad believes in sticking to one prestigious job and that buying a home is a person's best investment, whereas the rich dad believes that you should work at jobs that will teach you valuable skills that can help improve your career in the future, which will lead to better earnings, and that a home is as much an investment as it is an expense, and as an investment, might not even be that great of an investment. The rich dad teaches that one of the most important things a person should know is the difference between an asset and a liability. Assets are things that increase in value, or thought of differently, things that pay you more than they cost, whereas liabilities are things that decrease in value or cost you more than they earn you. This is hugely important in life. If you shift to this mindset, you are far less likely to spend a lot of money on things that lose value, like a car, and instead look to buy things that can gain value, like investing in stocks and bonds or buying real estate property to rent out. These first 8 books are fantastic. They teach a healthy mindset about work and money and how to wisely manage your finances. And importantly, they show you that you can do it by believing in yourself and taking the right actions to achieve your goals. One thing I noticed is how much they tend to emphasize the same things. And when you hear the same advice recommended by one expert after another in a field, you should probably pay attention. While these books are all you need, if you're really interested in the markets and investing, if you'd like to be above average, then there are several additional really great books to check out. Books so good that they've truly become investment classics. Number 9, if there was any one book that investors should read after learning the basics, I'd recommend A Random Walk Down Wall Street by Dr. Burton Malkiel, an economics professor at Princeton. Through an engaging read all about markets and different methods of trying to invest, the author leads us to the conclusion that you probably can't beat the market. He argues that it is difficult, if not impossible, for investors to consistently outperform the market over the long term, whether through technical or fundamental analysis. Instead, Malkiel advocates for a passive investment strategy, such as investing in low-cost index funds that track the performance of the overall market. He also emphasizes and explains the importance of diversification, asset allocation, and managing risk. 10. One of the greatest and best-known investors in modern times is Warren Buffett, who, against the odds, did beat the market for a long time, and in doing so built a net worth of over $100 billion. As a young man, Warren's investment mentor was Benjamin Graham, who wrote The Intelligent Investor about his method of investing known as value investing. The Intelligent Investor teaches Graham's philosophy and method of analyzing stocks and bonds and of building a portfolio, subjects every more educated investor should know about. One of the most important things Graham teaches is to buy assets with a margin of safety, meaning ideally for less than you think they're worth, because no matter how careful you are in your analysis of the investment, you could be wrong. He warns that no matter how exciting an investment looks, never overpay for it. He also talks about the relationship between value and price, that the more you pay for an investment, the lower your return will be on that investment. From these ideas, we're naturally led into the understanding that we should be happy for a bear market because we can buy stocks and investments at lower prices. Effectively, they're on sale, and who doesn't love a good sale? Number 11, in the book One Up on Wall Street by Peter Lynch, Peter argues that ordinary investors can be great stock pickers if they follow his guidelines for picking stocks. Peter was the portfolio manager at the Fidelity Magellan Fund during the 13 years when it was the best performing fund in the world, so he knows something about the topic, and his book is full of stories of the things he did right and the things he did wrong. He says that good investment ideas come from everywhere and that ordinary investors can do well by ignoring what the experts say regarding what to buy and instead invest in good businesses that they know and love from their daily lives. Examples from when he was investing included Dunkin' Donuts, La Quinta Hotels, and the investment companies themselves who were growing like crazy at the time. He also says that these ideas that we find in our daily lives are just leads though, and we still need to check that their financial statements are sound and the price of the investment is reasonable. Book number 12. Irrational Exuberance by Robert Shiller is a fascinating look at asset price bubbles, particularly in the stock market and real estate. Dr. Shiller is a professor at Yale University who won the 2013 Nobel Prize in Economics. This book was published right before the stock market peaked and crashed from the dot-com bubble in 2000, which he loudly warned about, and also addresses the housing bubble and crash in 2007 and afterwards, which he also warned about in advance. The lessons in this book are very insightful and relevant today, and the book has been updated through 2015 in its current edition. One important idea he discusses is that people often do things just because they see other people doing it, which in investing might be seen as a stock quickly rising ever higher because of a narrative that the company is doing something great, and so everyone seems to be buying the stock, which drives it up. As investors, we can be saved from a great deal of pain if we're aware of areas that might be in bubbles because they can suffer from steep price crashes. This could be very relevant again today with AI stocks soaring to crazy valuations and house prices at record levels of unaffordability. Number 13, in The Most Important Thing by renowned value investor Howard Marks, Marks spends 3 chapters discussing risk because of how important it is for investors to understand. You can't read these chapters and not fundamentally think differently about risk in your investing. For example, he points out that while most people understand that according to traditional risk-return theory and investment management, higher risk assets are expected to deliver higher returns to offset that risk. But he adds that he has yet to see the sexy but higher risk assets actually get priced lower due to the high risk. Instead, people often look at these investments and get excited about them because of high possible returns and thus bid up the price to the point where the downside risk eventually becomes far higher than the upside potential returns. Again, look at AI stocks with currently extraordinarily high prices. Might they go up? Sure. But if they start to miss expectations, they can go down a long way. Because the future is unpredictable, he emphasizes managing investments for both the downside risk as well as the opportunity for gains. Number 14, Fooled by Randomness by options trader Nassim Nicholas Taleb is a book that Howard Marks Our previous author said it's one of the most important books that an investor can read. The subtitle to the book is The Hidden Role of Chance in Life and in the Markets. This is such an interesting book with many great lessons to learn. For example, people tend to judge a decision according to whether or not it worked out, but that's the wrong evaluation, since luck often plays a larger role than we think in determining the outcome. Also, people are bad at calculating probability and misjudge the role of luck in our daily lives. He says that you are just as likely to fall victim to randomness and cognitive bias, even if you know about them. Because of the role that randomness or luck plays in our lives and in our investments, we should manage downside risk so that if things go bad, we can't lose more than we are comfortable losing. Number 15, in Unconventional Success, author David Swenson, the renowned chief investment officer of Yale University, explains why a simple portfolio is the way to go and why we should use low-cost index funds, diversify, and rebalance. In one chapter, he discusses the results of a study that showed that actively managed mutual funds are almost always a terrible choice. For example, once the impact of taxes are taken into account, over a 20-year period, only 14% of mutual funds did better than the Vanguard 500 index, and on average, those 14% only beat the index by 1.3% annually, while all the losers, those that didn't beat the index, on average did 3.2% worse than the index fund. Given that investors can't know ahead of time which funds will beat the index, the reward for somewhat randomly picking the right fund is extremely low. He also talks about the construction of indexes themselves, which can have a big impact on investor results, which is something I never would have thought about before reading this book. If you get nothing else out of it, which is impossible, the book's discussion of the impact of mutual fund and ETF construction, fees, incentives, and taxes is very helpful for investors to pick good funds and avoid the bad ones. 16. Last, but definitely not least, is the book You Can Be a Stock Market Genius by Joel Greenblatt, founder of Gotham Capital, who achieved 50% annual returns for more than a decade. Greenblatt specialized in finding investment gems in special situations, often hidden in plain sight because Wall Street wasn't looking at them. Things like a spinoff, which is when one company splits off part of its business, which then itself becomes a standalone publicly traded company. He also discusses mergers, acquisitions, and bankruptcies, and several other places to look for great investments. While the book sounds complicated, it's not. It's written in a conversational style. Greenblatt gives specific examples of things he found and invested in over the years, some that worked out great and others not so great, with the goal of teaching things that we as ordinary investors can be on the lookout for. Importantly, he also teaches the risks of investing in these areas and discusses how to make the investment. One example of a great story he tells was of investing in the pending purchase of Florida Cypress Gardens. His investment made, all the risks analyzed, he just had to sit back and wait for the acquisition of the park to close. But then the unexpected happened. The theme park that he invested in literally fell into a sinkhole, and he ended up losing money on the investment. That was definitely not part of his risk analysis, which reminds me of our discussion of risk in the books Fooled by Randomness and in The Most Important Thing. So, to try to conclude after these 16 books, if you're interested in just getting a solid understanding of how to think about money in your life and getting your finances and basic investments set up, choose a few of the first 8 books. Once you pass those, though, you'll find yourself hungry to learn more about risk, the markets, and portfolio construction as taught by some of the most interesting and successful people in the business. Then dive into some or even all of the remaining books on the list. Books 9 through 16 are must-read for fans of the markets and investing, and definitely for anyone wanting to get into the business. Coming from this inspiring project, if there's anything I want you to do, it's for you to take control of your finances, and that includes your source of income, and invest wisely. It will have a huge impact on your life and your future. Remember, mindset is really important to your success in life. Don't start with the words, I can't. Train yourself instead to say, I can, then figure out how and go do it. I hope you found this interesting and inspiring. Hit those like and subscribe buttons to join me in future videos. I'll see you in the next one.